Good morning. This is Jim Barlow with OakTree Strategic Leverage. Happy to be here this morning. It's a okay day or a great day. Um, this is the second time I've given this presentation, and I spent a bunch of time, I think, improving it. I want to make it'll probably be a little different next time, but anyway, inversion thinking and retirement income. Why Kaizen works when other strategies fail. Let's get started. Most financial failures don't come from what you see, like the iceberg there. The majority of the iceberg you can't see. They come from what they don't see. These are the problems that hurt people. Kairos Aurelius, retirement is rarely lost in a single mistake, is quietly surrendered, one unexamined decision at a time. Put it also in Latin and Arabic. Aramaic? Anyway, notice Latin uses the same word retirement. The conventional question most investors ask is, how much can I make? What do you think we can obtain? The better question, how do I avoid losing? Charlie Munger, he's famous of Berkshire Hathaway with Warren Buffett. He said this years ago, tell me where I'm going to die so I won't go there. You have to think two or three times to understand that, but he was thinking about inversion thinking. I want to know what could hurt me. He's actually passed away, so I guess he went there. Don't focus on how to win. Focus on how not to lose. So how do people fail at investing? Emotional decisions. Fear locks in loss. 35 years as an investment advisor, I had clients that so hard to get them to be patient, to sit tight. I'm going to do some articles in LinkedIn on some of these and leave their names empty, but emotional decisions, that's the first one. That's how people fail. They make bad decisions. They say, I want out. Another one is early losses and sequence risk. That sequence risk is a big one. If you were retiring January 1st, 2008, and let's say you had $2 million and you said, 2 million, I'm set. I can take out 5% a year, 100,000, I'll be fine. But by a year later, you're down 37%. And then you're selling something to get your 100,000. Sequence is terrible. Unprotected leverage. 2008 is another good example. There is a lot of people throughout the country, real estate investors, who bought apartment complexes 2 or 3 years, in advance of that, sometimes with nothing down. And I was involved in picking up the pieces and making some money here. But example, they buy an apartment complex for $2 million. It went down to $1 million after 2008. They quit making their payments because it's a 5-year loan, and so they walked away, destroyed their credit. The bank took them over, and then I have a company that I use that they would buy properties from the bank, not at $1 million, but probably 500,000, 600,000. So unprotected leverage can destroy you. Taxes, quiet compounding drag, and the way, I don't want to be too political, the way government spending, tax rates are going to go up. And inflation erodes real value. We're always going to have inflation. We always have. These are the major 5 way people fail at investing. So if this is how people fail, why don't we design strategies to remove these failures first? Let's solve backwards. Inversion thinking. Let's, as I've said, don't ask how do I win. Ask how do I avoid losing. I turn my tree upside down, and we're going to examine the roots. We're going to examine the ways things can fail. That in the wind, do we have strong enough roots to keep that tree alive and up and not be pushed out? Anyway, I thought that was cute. I've done that before. So a 50% loss takes 100% to gain back. Wow. How do I avoid losing? I found this just last week, a little chart. So here's the problem. What would be a bad solution? Once you did identify this bad solution, how can we avoid this bad solution? That way, having a good solution. I like that. A better design philosophy before growth. Fragility. You know, in all my different work, they were always using that word, fragility. And I thought it was a little funky, but I understand when a package comes in the mail and it says fragile. And if we drop the box or whatever, we break something, it's gone, it's ruined. We eliminate something being that fragile. Before upside, we protect control, we protect the downside. This is inversion thinking applied to wealth. Inversion thinking applied to football. I was playing around on AI, and can you imagine? So AI did a great job. That's me. I gave myself some pretty buff arms. I didn't change my face or my hair. It is white. I gave me Steve Young's number. I'm a BYU graduate and fan. And I put Utah there in red in the back. But anyway, a little fun to have a little AI fun. Inversion thinking applied to football. Don't ask how teams win. Ask how they lose. Games are lost because of turnovers. There are some of these in the NFL, these playoff games. Some teams just made one mistake, a turnover, got a pick 6 on them, and lost the game. Missed assignments, causing turnovers or interceptions, penalties at critical moments. You've seen, oh, that touchdown's coming back. There's a holding. Poor situational decisions. Championship teams don't win by being aggressive. They win by being mistake-proof. I think the Super Bowl the other night, I think they're really sensitive about making mistakes. They were kind of a conservative played game for the most part. Not being aggressive, but they win by being mistake-proof. Why retirement plans fail? Retirement changes everything. You're no longer accumulating, you're withdrawing. Losses are permanent, not temporary. 2008 example. Sequence risk moves from theoretical to lethal. Get my tongue moving here. Timing matters more than average returns. Income depends on the structure, what you set this thing up as. Get my, oops, sorry. Well, I guess I can't get rid of my thing at the bottom. Well, we'll keep going. Okay, sorry. So income depends on structure, putting this thing together so it can't fail. In retirement, you don't get paid to be patient. Wow. Traditional assumptions. Traditional income planning assumes withdrawals are well-timed, taxes stay manageable, emotions don't interfere, and time is forgiving. Well, time is forgiving for a long-term investor. Retirement income fails when even one of these break. What happened when stress hits? Why does markets don't warn you? Life doesn't schedule itself conveniently. 2020, 34% drop from February to March. This is the COVID. 2008, portfolios down 38% when income is needed. Going back, 2000 was -9, 2001 was -12, 2002 was -22. I remember holding hands with my clients through those 3 years. And it was hard for them, hard for me. At these moments, volatility isn't the enemy, forced action is. Problem is, in return is timing. The question becomes, who has options and who doesn't? Kaizen, which we're going to show you a little bit about, designed for the moments plans usually fail. If this is how retirement income failed, the only responsible question, what would an income strategy look like if it were designed to prevent failure first? Enter Kaizen. There's my tree, upside down. We remove loss, potential loss, timing risk, tax uncertainty through the structure. Then we yet let leverage do what it does best, grow. Traditional planning starts with growth. Kaizen starts with survival. Most plans fail because returns, not because returns were too low, because decisions were forced at the wrong time. Common failure points, selling during market declines, income arriving before it's needed, whereafter it's critical, taxes compounding quietly against the plan, leverage applied before risk is controlled, liquidity disappearing under stress. When pressures arrive, structure decides the outcome. I'm going to give you more detail, but some basic few things on Kaizen. We remove loss. You can't have a negative year. 2, the outcomes are protected from taxes. We're going to take it out tax-free, all your returns. Leverage without personal risk. There's no collateral. There's no way that $2 million real estate that you have to walk away from it when it doesn't go down, and we're not on the hook. Structure is how this is happening, and we have the liquidity, whatever the situation is, when it matters most. I built this. There are some charts I took out, but I just like this one. So Kaizen removes failure by design. No negative market years. No current tax drag. No outside collateral. No personalized guarantees. No forced liquidations. No required minimum distribution pressures. No margin calls. Growth comes second after the risk is engineered out. I like that one. Designed to support outcomes. This is who's buying Kaizen. The number one reason is supplemental retirement income, which is our topic today. 2, tax efficient income planning. Family gifting, wealth transfer. That's next week's webinar. Executive employee retention. So many people move jobs so often today. You need to figure out a way to is a 401k really holding them? But this has some meat to it that it could really hold your great employees. Business succession planning. You've got to build up assets to be able to buy out the other people, and you need insurance to have a successful succession plan. Charitable and legacy goals. There's a lot of uses for Kaizen. We're talking primarily about the one. High earners approaching retirement, like it. Retirees concerned about sequence risk. Investors who value control over upside. Those prefer structure over speculation. This is not about beating the market. It's about surviving retirement. So I've put kind of the whole all the little ins and outs about Kaizen into 3 categories: the foundation, the growth part, and the control. The next 3 slides have a lot on them, and I'll go through it. But so try to be I can spend a lot more time on each one of these. First, you have a death benefit. You have a legacy to protect your family. It's life insurance. And along with this life insurance, you have living benefits, disability against accidents, sickness. You have long-term care coverage. The living benefits of today are phenomenal. So death benefit and living benefits protect today, legacy tomorrow. Then tax-free growth and access. This is money you're not going to pay taxes on by doing the strategy correctly. Not going to give detail today, but it's going to be tax-free income. No management or advisory fees. I charge 1% a year as an investment advisor. This has no advisory fees. The investments I chose, the mutual funds or whatever, usually had management fees of 1%, 1.5%. This doesn't have management fees. It does have life insurance fees, but these are actually, with time, you're getting life insurance eventually free as you be patient, because you're going to have a growth asset that performs. That's the 3 things that life insurance brings to the table. Life insurance, living benefits, tax-free, and no management or advisory fees. That's the foundation. Then we have the growth part. A few years ago, about 20, not that long ago, they came out with an insurance called Index Universal Life. You can have market-linked growth, I'm talking about the second one first, with upside like the market. And you have 0 downside risk, no market losses, downside protection. You, in a negative 37% year or a negative whatever, in that bad year, you get 0. A lot easier to start growing from not losing. I think I'm going to add for a future one a slide how that happens, but I haven't done it today. Last is control. We have the third one down, trust ownership. We set this up as a trust for you. We set it up for a master trust to manage all the policies. And that trust is the one getting the leverage, the borrowing, the growth. They're doing the nitty gritty without any collateral on yourself or any signature or loan documents. So it's trust ownership, institutional leverage, 5 payments only. The system is 5 payments. That's short. This can be just very turnkey. With that, no downside. You can just leave this alone. You don't need to worry about how it's performing. It's going to work. And then liquidity and flexibility. I should put a caveat there, maybe an asterisk. Not in the early years. The early years, you're building up this system. But then, access to cash values, no RMD required minimum distribution. Then you have real flexibility, real liquidity. There's a lot of things that the founders of Kaizen did to make sure this thing happens, but that's kind of the results in this page there. This is how the payments look. You have 5 annual payments. That's the silver picks. The bank is putting in approximately the same for that first 5 years. Then they're continuing their payment that they were paying, plus they're picking up the amount you were paying for the first 5 years. Graphically, it looks like about 3 to 1, which it is. I'll show you shortly. All without the typical risks of borrowing, no credit checks, no loan documents, no personalized guarantees, no signature, no collateral, none of these things. We have a lot of tools, some fun tools to help you decide if this is for you. Kind of the real powerhouse landing page is called ILIA. That's in the upper left corner. Interactive Learning Information Assistant. Kind of a funky name, but this site has really a lot of detail. There's the what it says on the left side, estimate my benefits and all kinds of things, videos. Anyway, this is a site I use all the time. And you can too. You can have a login for access to it. I'm going to do a hypothetical person. Give you some numbers to a reality. 46-year-old male, excellent health, putting in $70,000 a year for 5 years. Why did I choose 46 and 70,000? This is the average investor in Kaizen. The average investor is 46, and the average investor is putting in 70,000 a year. There are people putting in more. There's people putting in more, closer to the minimum, which is, depending on age, about 20, 25,000 a year. There's people putting in $1 million a year over 5 years. So this is the hypothetical. We're going to begin distributions at 65 and make sure we're income through 90. We're going to use a growth rate of 6.81. I calculated these things on January 24th, so not that long ago. And this is subject to NAIC regulatory guidelines. NAIC is National Association of Insurance Commissioners. These are guys in every state. Insurance is not regulated by the federal government. It's regulated by every individual state. And this association has come together to form regulations that they ask companies to follow. And the 6.81 is the authorized illustration rate. I'm not showing it today, but the average for the very first policy is around a little under 9%. So the return is nice and long-term about as good as the market. We're going to use long-term capital gain rates at 20%, income tax rate of 37%, assumed asset management fee of 0.5. Let's get started showing you some numbers. This is the graph. I'm going to keep putting some layers on. But if this 46-year-old male put that 70,000 in per 5 years at a 6.81 at a regular investment, in other words, he's paying taxes as it grows, then at 65, he could start taking out 48,642 a year, 58,642, and through age 90, he'd have pulled out 1,524,688. That is the maximum amount at 6.81 you can pull out a year, because what I did, I used every penny in that calculation. 91, I have zero income. I used every penny. So it really is the maximum possible. There's another option this person has. That'd be tax deferred. This is an IRA. This is a 401k. Wow. This tax deferral strategy has changed that income on the 6.81 to 74,106 a year. In other words, the tax deferral IRA worked. Now you're getting $1,926,000. So, a little snare drum. What I did the snare drum for is the next line is going to be Kaizen. I'm going to show you how Kaizen, for this 46-year-old person, what kind of income he'd get from Kaizen. So, what do you think? 74.58? Do you think it'll be 84? Maybe 94, maybe 100,000. Well, drum roll, please. Let's bring the curtain back. Oh, my lands, 130,000. This person would be pulling out 3,380,000 from 65 to 90. And guess what? There's money still left. He can keep on taking money out. The death benefit when he started at 46 was $2 million. Death benefit at age 90 is $1.7 million. How much? Whatever the cost of the insurance, he overcame that and passed these other accounts. It's as if he got free insurance and a better return. So, the two worst case environments. I don't know if you recognize that photograph. It came from the Great Depression, 1930 to 32, the worst sequence of returns in U.S. history. And so what we did to stress test Kaizen in this era, we put 9 years of zero over 12 years. Notice zero, can't have a negative year. So that 9 years of zero, that's a lot of zeros. Let's see how Kaizen does. And we got the other stress test. We've got the high interest rates of the 1980s. Interest rates got as high as 16.88. You know, I was married in 73, and we bought our first house in, well, let's see, 75. Was that next house in 76? And well, we know about high interest rates. So would Kaizen work in this high interest rate market? Well, we did that stress testing. Kaizen was stress tested on both of these. Okay. So in the Great Depression, instead of 130, it would, in this era, it had been 84,500. Still 10,000 over the tax deferred. And we didn't do the worst, we did the 6.81 for the 74. So in the worst, we've outdone the tax deferred a lot better than the after tax. I'd rather have the 130. How'd it do in the 80s? 97. Better than the 84. Wow. So in a down bad time, Kaizen worked. Well, I've got another drum roll, snare drum. I've got something else to show you. Let me tell you the details. Allianz, it's one of the insurance companies we use. They're the world's largest insurance company. They wanted to see if this ILIA illustration system that we had built was accurate. We want to make sure these numbers are not lies. And so they evaluated this system and they said, wow, they think there's an 80% chance that it's not going to be 130,000, an 80% chance that it's going to be, drum roll please, and curtain call, double. It's not going to be 130, it's going to be 80% chance of 260,000. So there's the range, 84,000 to 260,000 at the 6.81, 130. Wow. Now I did something else, new this time. How do you like that? I changed this to a female. Instead of a male, instead of 130, it's 133. Better health, longer longevity, they live longer. So if you're female, it's even a better scenario for you. Just a little bit. I did something else too. I did a paper airplane for that. What if this guy is not excellent health? What if he's average health? Because health makes a difference in life insurance. Well, instead of 130,000, it's 120. Wow, that's not too bad. Still a lot better. The stress test numbers didn't change. Oh, the test numbers did change. I should go, well, I won't. Anyway, and with the double 240, so even if you're just average health, Kaizen works. Now, not to dwell on this, but much slower than average health, you can't buy Kaizen. It's not available. You got to have average health or better. Well, there's the numbers. Let me show you some other tools. We have a landing page that has 10 chapters on different sections of Kaizen, has videos, and there's the QR code for it. You don't have to give me your name. You don't have to give me your phone number. You don't have to give me your email address. This is just available for you. And if you have questions, that site, the top part shows that they have my number. You can call it. This is a great resource. No pressure. Learn as you want. This is a great landing page. We got a second one. This one is about gifting. It's still Kaizen, but it has this special angle. If you're my age and you're buying this for a granddaughter or a son, it shows how it would work for you in gifting. And there's a QR code for this one. Now I'm back to the ILIA. When you get to this one, you have to have a login, and you don't need to start here. To start here, I need to give you an invitation, so I do need your name, and I do your email address and your cell phone number. Not a lot of information, but eventually, as you graduate from those, you'll want to come here. My website, I've got a lot of quick links, a lot of things that help you. You can go there. Got lots of videos, got a lot of, every webinar is recorded. This is being recorded. It'll be posted on my website. You can rewatch this one. I've got a retirement income calculator that I built. Really proud of it. It'll help you easily decide if you have a retirement income gap. And I've got a basic and a more detailed one. Great resource, free. So there's those 2 QR codes. I got kind of 2 ways to implement Kaizen into your life. How you're going to engage. One is this online with those 2 QR codes, those 2 sites. Advisor back whenever you have a question. Learn at your own pace, digital engagement, OakTree guidance as you want it and as you need it. Or you can be very traditional. I'll take you to lunch. We'll do a one-on-one. We'll talk about the legacy, the family planning, the personal strategies. Just talk it over and see if that's what you want. Either one, I'm happy to help people how they can be helped. It's the same strategy, just different engagement style, your decision. The right path fits how you think and decide. Here's my inversion thinking webinar sequence. Last week we had the flagship. Today we're doing the retirement one. Next week we're doing the family gifting. Then those are monthly. Then I plan to do bi-monthly, the executive employee benefits. That'll be the last week of this month. Then the other months, so I'll be doing a business succession webinar. Then quarterly, I'm gonna, most of these haven't been built. They're still in the thoughtful area. So inversion thinking and leverage, all about leverage. Another one, inversion thinking and market volatility. Last, inversion thinking and taxes. So that's our sequence of webinars. And here's the last 2 after today, this month, the family gifting next week, and then the employee retention and benefit the last week. And you can take a screenshot of that page, and there's the login to go to the website, which to the webinar like you've done today. Another Kairos Aurelius quote: "The first act of wealth is not growth, is disciplined removal of failure." Another one: "What endures is not what promises the most. What endures is what fails the least." And there's my upside down inverted inversion tree. And there's my picture and a little bit on the inversion, the Keystone webinar. It's on my website too. If you haven't seen that, you can go watch that one. It's the latest one. I replace as I do new ones, I replace the old one. And there's the QR code too, and there's my phone number and email and website as you have questions. And 11:39, I'm sorry, I like to do this in a half hour, went a little over. That's it for today. Hope you've enjoyed it, and hope to have you answer questions on the phone, however you want to engage. Happy to help. Have a great day.